Mental accounting is a concept that was propounded by Dr. Richard Thaler. Richard Thaler is a Nobel Prize awardee, an expert and an exponent in behavioral economics. He propounded that as human beings, we maintained two accounts in our mind. Money is always either open or it's already segregated, like pigeonholes, where we kind of keep it stored for a particular cause. And mental accounting has great implications when it comes to investing. Now let's understand it through an example. Let's say you had a ticket that you bought for 5,000 rupees to attend an IPL match. As you are entering the stadium, because of all the crowd, you discover that somebody has kind of taken that ticket out of your pocket and you've lost the ticket. Would you then go pay another 5,000 rupees to buy a ticket and go watch an IPL match? Scenario 1. Now the second scenario. Let's say you had 5,000 rupees, you were passing by a stadium where IPL was happening, and at that point in time you lost that 5,000 rupees. But just so you feel like watching an IPL match, would you go buy a ticket for IPL and watch the match? That's the second scenario. In both the scenarios, the loss is the same 5,000 rupees. And in both the scenarios, the cost of a new IPL ticket is the same 5,000 rupees. But guess what? 99% of all the people who were given this scenario said in the first instance, they will not buy a ticket. The primary reason being is that in their mind, 5,000 was already allocated towards an IPL ticket, and paying another 5,000 meant they were paying double the amount. In their mind, it was a wrong thing to do. Whereas in the second case, although they lost the same money, they hadn't allocated it for an IPL. So to that extent, their mind allowed them to spend the 5,000 rupees additionally so that they could buy tickets. Now, this is a very simple example because at the end of the day, money is money. It is fungible. It can move either which way. Is your taxman kind to you? That's the other. And this is a very common scenario that we see play out. Every time tax refunds come, you see people go out and splurge it on things that they don't need. What is a tax refund? Tax refund is nothing but the tax that I ought to have paid lesser, I have paid more, and then I apply and then get a refund. It's money that's due to me, which has been maintained by the government. Yet, most people react very differently when they get a tax refund. They think it's time to celebrate, time to enjoy, go out there and spend money. Second example, all lottery winners go bankrupt. Have you heard this? Yes, it's true. Most people who win lotteries go bankrupt within a few years. And the reason is very simple. In their mind, this is extra money that they hadn't bargained for. So they're very careless about spending this money in the way in which. So they buy a lot of stuff, they gift, they loan to people who they're not sure whether they will get the money back. And yet, it's the same money that they get even when they do hard labor. Yet in their mind, money seems very different when it comes from a lottery. And which is why 90% of all people who win lottery don't know where the money went 3 years after that. These are all classic examples of how mental accounting plays a role in terms of managing one's money. In the investment world, it's even more impactful. I've come across investors who have two very different buckets where they invest. One bucket is a safety of an FD, where they certainly don't want to lose anything, including their principal and return, even if the return is very, very low. And the other bucket is what is called a cryptocurrency bucket, where they're willing to lose the principal and the return. They're willing to take that big bet. And I have heard investors tell me that, you know what, I'm willing to forget about this money. If it comes, it's a bonus, but if it doesn't come. And that's where we make our mistake. Because money, at the end of the day, is fungible. There is no money to lose and there is no money to gain. It's all the same money. And it's very, very important that we realize that we should get these compartments out of our minds. There are three ways one can look at overcoming mental accounting. One is to look at the big picture. Always look at money from a holistic perspective rather than in individual asset classes. And that way you can certainly overcome. Second is always look at money from a perspective of how it is going to help you fulfill your goals. Rather than trying to take these short-term calls, if money is available and invested for your particular goal of reaching something, then it works much, much better. Last but not the least, always rethink the argument whether this is a mental accounting process that you're caught off. And I'm sure your decision on money will be much better.